In this video, I will cover reasons why dividend investing may not work for everyone. This is especially true for younger generations of investors. I understand why people like dividends. It gives them the comfort, the recurring checks that allows them to pay their bills. But it's very important to make a broader comparison of dividend investing to other categories of stocks. First, on historical basis, growth stocks outperformed anything out there, including dividend stocks. I will use Nasdaq 100 index as the basis for comparison. Nasdaq 100 index consists of 100 largest, non-financial mostly, companies that are traded on Nasdaq Securities Exchange. In my previous video, I went over reasons why Nasdaq 100 is the best option for growth stocks portfolio addition. For instance, here's the table showing total returns for SCHD, QQQ, and SPY ETFs. SPY follows S&P 500 while QQQ tracks Nasdaq 100. SCHD is a popular dividend ETF. Note that the total returns account for both dividends and price performance. The analysis assumed dividend reinvestment. Everything is before taxes. For available periods, the difference is big. Even several % differential has a large effect long term. Okay, you may say, the time horizon is too short to make a comparison. Let's expand it. Unfortunately, SCHD was not around before 2011, so I will have to use something else. If we assume that SCHD matched the performance at least of S&P 500, we can use S&P 500 as the basis of comparison. So with this assumption, let's make a comparison. Comparing S&P 500 to the Nasdaq 100 ETFs, we see that even for a 15-year period, the outperformance is clear. Let's expand this period even more. The earliest Morningstar started tracking S&P 500 total returns was in 1989. The total return from that date through 2023 was 9.92%. What about Nasdaq 100? Unfortunately, no total returns for Nasdaq 100 are available. For this reason, I will use price returns and exclude dividends. Historically, dividends played a small role for Nasdaq 100. Even now, its yield stands at about 0.7%. Based on my price return estimates, Nasdaq 100 returned 13.1% per year, still higher compared to S&P 500. Even if we include a small dividend yield in here, the total returns may be slightly higher. Either way, the outperformance is still there. One argument in favor of dividend investing is the reduced volatility. Modern portfolio theory says that volatility is a good measure and it is a measure of risk. So any investments that tend to fluctuate a lot, they tend to be penalized, so their returns are adjusted down. But really, is a volatility a good measure of risk? Wouldn't you want to get a better performance in return for experiencing a little bit more volatility? And investment risk, in reality, is the probability of a permanent capital loss. That's what I think, and that's what other prominent investors think, such as Howard Marks. And with investing in ETFs, the funds that track indices, the permanent risk of capital loss is largely eliminated by design, because most of these indices, they're like momentum investing. So by design, only the strong stocks remain, and the weak ones that tend to lose their momentum and their market capitalization tend to be dropped out from the index. Moreover, if Nasdaq 100 is down, it's very likely that S&P 500 or SCHD are down too. Next, let's tackle another issue. Most of the advertised returns for dividend stocks and indices assume that you reinvest dividends. If you do not reinvest dividends, the performance difference between what they advertise and what you actually get can be quite big. And over the long term, the compounding will play against you. So if you're still determined on doing dividend investing, make sure that you have your dividend reinvesting the plan enabled, or you enroll in it with your investment brokerage. So every time you receive a dividend, it is reinvested back into the stock or index, either as a fractional share or whole share. Another issue that dividend investors must grapple with is dividend taxes. And this is only true for taxable accounts. If you're holding your investments in tax-deferred accounts such as 401k or IRA, this is a completely non-issue. But for taxable accounts, the dividend taxes can be significant, and while not a whole lot, but they still can make a difference in your performance for your portfolio over the long term. The dividend taxes can range from 0 to 20% for qualified dividends, and depending on your taxable income. And if the dividends are not qualified, they will be taxed as an ordinary income, and so the tax rates there are from 0 to 37% plus for federal and plus the state taxes. So if you're a young investor and you have a high salary and you're not investing in dividend stocks through tax-deferred accounts, you will be paying likely taxes in your taxable account. So even if you enroll in dividend reinvestment plan in taxable account, you will still be paying dividend taxes. I made a video about all you need to know about dividend taxation that I linked above. Also, taxes become an issue with real estate investment trusts or REITs, and this is also true for taxable accounts. So it's a non-issue for tax-deferred accounts. So if you invest in REITs, the distributions from REITs are taxed as ordinary income for the most part. And this tax rates for the ordinary income can be as high as from 0 to 37% for federal taxes and plus state taxes. So depending on your taxable bracket or your taxable income, you may be facing additional and higher tax rates compared to, let's say, qualified dividends from corporations. So that's another issue to remember. Let's say you invest in realty income stock, which is traded under the ticker O, and it has a yield of 5.8%. Let's say that you will be paying a dividend tax that is by 20% higher compared to, let's say, qualified dividends. In this case, your after-tax effective tax yield becomes 4.8%, right? 5.8 minus 20%. And so if you find an equivalent investment with a yield of 4.8% that pays qualified dividends and qualifies for lower tax rates, these are the same. So it's very important if you are young and you are investing, let's say, in REITs, or even not necessarily in REITs, but any other dividend stocks, make sure that you invest in a tax-deferred account. If there's one major reason for investing in dividend stocks, it is the investor's preferences. As people get older, what they like and what they dislike changes. As you approach retirement, the pursuit of the highest growth possible becomes less important. Moreover, as the people get older, they're becoming more and more risk averse. So what does it mean, risk averse? In economics, risk aversion says that you prefer certainty over uncertainty. Or in other words, you prefer income today versus unknown price appreciation tomorrow. Many retirees want to avoid stressing over bear markets. They don't want to think too much about market recoveries or timing of their selling. At some point, it all just doesn't really matter. It's not like that extra cash that you earn, you can take with you to the grave. It doesn't matter anymore. The dividend income provides that desired safety cushion, meaning no matter what, the dividend income check will arrive the next month or next quarter. And it's okay that dividend investing comes with a somewhat smaller returns compared to alternatives. At least, dividend income will help retirees pay their bills tomorrow. On top of that, they don't have to stress about the selling and timing of the selling. If there's one reason to engage in dividend investing, it is this: the investor's preferences. I see many counter arguments to growth investing, but none of them can deny the fact that growth stocks portfolio outperformed many things out there. At least this is true on a historical basis. As technology and AI plays a bigger role in our lives and in society, it is very likely that Nasdaq 100 index will continue outperforming everything else out there. So better returns elsewhere can make dividend investing less attractive. Also, dividend reinvestment is somewhat an issue, and so are the dividend taxes in taxable account. So it is very important to invest in dividend stocks in a tax-deferred account with dividend reinvestment plan enrolled. But what if you are young and you earn income that can cover your living expenses and you can save for the next 20 plus years? I would say that Nasdaq 100 is a much better option for the long term and better performance. That is it for this video. I hope you learned something and you got something out of it. Please give it a like and subscribe to my channel for more content about investing and personal finance. With that, thank you and see you next time.